To be honest, most of us don't lie awake at night worrying about the value of the Australian dollar. It's not the kind of thing that sparks heated debates at backyard barbecues or over Sunday roast. But maybe it should be. Because that little AUD ticker at the bottom of your finance app, it tells a much bigger story than most people realize. A story about a country that once stood tall during the global financial crisis, rode high on a mining boom, and flirted with a dollar stronger than the US. And yet today, the Aussie dollar is stuck, hovering at 65 to 68 cents, and slowly sliding out of relevance on the world stage. This isn't just about exchange rates or travel costs. It's about the underlying health of our economy, our reliance on volatile exports, our productivity slowdown, our political choices, and our shrinking global competitiveness. The dollar is a mirror. And right now, what it's reflecting back isn't pretty. So if you've ever wondered why your overseas holiday is getting more expensive, or why Australia seems to be falling behind economically, this is the episode you need to watch. Let's pull back the curtain on why the Australian dollar just can't keep up. The good old days. There was a time, not too long ago, when the Aussie dollar was strong. In fact, back in 2011, it wasn't just holding its own against the greenback, it was beating it. The Australian dollar soared above parity with the US dollar, peaking at around 110 USD. It was a golden age for Aussie consumers. People were shopping online from the US like it was Boxing Day every day. Imported electronics, clothes, furniture, you name it, suddenly felt like bargains. Overseas holidays? Dirt cheap. Americans joked about Australians flooding their cities with tourist dollars. Australians joked about how much more luxurious life felt with a dollar that could go toe-to-toe with Uncle Sam's. But those days are long gone. Fast forward to 2025, and the Aussie dollar is struggling to stay above 65 US cents. It's been stuck in the mid to high 60s for years. And the dream of ever returning to parity? That's starting to look like a relic of a bygone era. Some economists say the Aussie dollar could dip further in the coming years, not rise. So, what happened? How did Australia go from economic overachiever to currency underdog? And more importantly, what does this mean for the country's future? The answers, as you'll see, are both revealing and uncomfortable. To really understand why the Australian dollar behaves the way it does, you need to know one crucial thing. Australia has a commodity-based currency. That means the value of the Australian dollar tends to rise and fall with the prices of raw materials, especially iron ore, coal, natural gas, and other key exports. These commodities are the lifeblood of Australia's trade economy. And during the 2000s and early 2010s, when China was growing at breakneck speed, this was a winning formula. China's insatiable demand for Australian resources fueled a mining boom that propped up government budgets, drove national growth, and yes, strengthened the Aussie dollar. At one point, iron ore made up more than 40% of total export value, and the AUD soared in tandem. But here's the problem with tying your currency to the global commodities market. It's a roller coaster. Commodity prices are notoriously volatile. They swing wildly with global demand, geopolitical tensions, and supply disruptions. Just look at 2021, when iron ore prices fell from over $230 a ton to under $100 in just a few months. The AUD took a direct hit. Even though prices have recovered since, the long-term uncertainty makes global investors nervous. They know that any sharp drop in commodity prices will likely drag the Australian dollar down with it, fast. And that's not a risk everyone wants to take. The China factor. Australia's economic heartbeat is tightly linked to one customer above all others, China. Around 1/3 of all Australian exports, from iron ore to coal, natural gas to agricultural goods, end up in Chinese ports. For years, this relationship helped fuel Australia's prosperity. But now, it's starting to backfire. Because China's economy is no longer the engine of global growth it once was. After decades of rapid expansion, it's hitting some hard limits. Structural problems, like an aging population, ballooning debt, youth unemployment, and a housing market on shaky foundations, have forced China to pivot away from construction-heavy growth. Instead, the focus is shifting to domestic consumption, tech, and services. And here's where that hurts Australia. Fewer construction projects in China mean less demand for steel. Less steel, less iron ore. And since iron ore is Australia's single biggest export, when Chinese demand slows, so does the value of the AUD. Then you add geopolitical friction to the mix. Australia's moves, like banning Huawei, joining the AUKUS Pact, and raising human rights concerns, haven't gone unnoticed in Beijing. The result? Trade restrictions on Australian products like barley, coal, wine, and lobster. This kind of tension creates one thing markets hate: uncertainty. And in currency markets, uncertainty equals risk, and risk drags the currency down. So it's not just economic forces, it's diplomacy too. Let's bring in another major player in this story: the Reserve Bank of Australia, the RBA. Now, here's how it works. When central banks raise interest rates, their currencies typically strengthen. Why? Because higher rates offer better returns for global investors. Park your money in a country with high interest and you earn more. Simple as that. That's exactly why the US dollar has been flying high. The Federal Reserve took an aggressive stance against inflation, jacking up rates to over 5%. It drew in global capital like a magnet. Investors rushed to buy USD-denominated assets, and the dollar soared. But the RBA, much more cautious. While inflation did hit Australia hard, the central bank had a tough balancing act. The RBA capped interest rates at 4.35%, significantly below the US. Why? Because Australia has some of the highest household debt levels in the world. A sharp rate hike could push already stretched homeowners and borrowers into serious trouble. So the RBA played it safe, but playing it safe has a cost. Global investors looked elsewhere for better yields, particularly the US. That reduced demand for the Aussie dollar, further weakening it on the global stage. And now, the RBA is caught in a trap. Raise rates too high, and households suffer. Don't raise them enough, and the currency suffers. Either way, the AUD stays stuck. Now let's talk fundamentals. Australia's productivity problem. Let's be clear. Currency strength isn't just about iron ore and interest rates. It also reflects how competitive and dynamic your economy is. And on this front, Australia is falling behind. Over the past decade, productivity growth in Australia has stalled. According to the Productivity Commission, we're now seeing the slowest rate of productivity growth in 60 years. In simple terms, we're spending more time and resources to produce the same, or even less, output. That's a red flag. Why does that matter for the Australian dollar? Because over the long run, strong currencies tend to come from strong, efficient economies. Countries that improve productivity, attract foreign investment, create high-value exports, and build industries that don't just rely on pulling stuff out of the ground. Think tech, think advanced manufacturing, think innovation. But Australia. We've leaned hard on population growth and the mining sector. We haven't done enough to foster a competitive, high-tech, high-productivity economy. Instead, we've been content to ride the boom times without investing in what comes next. And when investors look at Australia now, they don't see a country on the cutting edge. They see one that's coasting, vulnerable to shocks, and increasingly dependent on volatile exports. That doesn't inspire confidence. And it doesn't support a strong currency either. Let's imagine Australia decides to diversify away from commodities. A smart move, right? After all, depending so heavily on raw materials is risky. But if not iron ore or coal, then what else do we export to the world? The answer lies in services, particularly education and tourism. These are Australia's top two service exports, and together they're worth around $50 billion a year. Our universities attract international students in huge numbers, and our beaches, cities, and natural wonders bring in millions of tourists. But here's the issue. These sectors are fragile. COVID-19 proved that in brutal fashion. When international borders slammed shut, education providers lost billions. Entire towns built on tourism, places like Cairns or parts of Tasmania, were economically gutted. The bounce back? It's been decent, but nowhere near strong enough to boost the currency in a meaningful way. And unlike sectors like advanced manufacturing or tech, education and tourism lack scale and resilience. They're exposed to global health crises, recessions, and political headwinds, just like commodities. So even if we try to move beyond mining, we're still left with a narrow and shock-prone export base. A few bad headlines, a diplomatic standoff, or another global shock, and demand drops, revenues fall, and the Aussie dollar dips once again. It's diversification, yes, but not the kind that strengthens a currency long-term. Now looking inward, foreign investment and the housing trap. Australia's love affair with real estate is no secret. For years, housing has been seen as the safest bet, our national sport even. But while skyrocketing home prices have created wealth for some, they've also made Australia one of the most unaffordable countries in the developed world. What's less talked about is how this obsession with housing is hurting the Australian dollar. When Australians pour their savings, debt, and investment into existing homes, it doesn't create new products, new technologies, or new industries. It just recycles wealth within the domestic economy. Buying and selling the same houses back and forth at higher prices may make some people feel richer, but it does very little to boost productivity or international competitiveness. And here's the currency connection. Productive investment in innovation, manufacturing, tech, R&D attracts foreign capital. It tells global investors that an economy is growing in real terms, not just in asset values. But when capital is locked into property speculation, foreign investors see fewer long-term opportunities. Add to that tightened restrictions on foreign buyers, rising global competition for capital, and Australia's increasingly narrow economic focus. And what do you get? Less demand for the AUD. We've become a nation where investment chases property portfolios, not patents. And that, over time, erodes the foundations of a strong currency. Budget deficits and global risk perception. Running a government deficit isn't automatically a red flag. In fact, most countries do it. It's a tool to manage economic growth, fund services, and respond to crises. But in uncertain global environments, deficits, especially current account deficits, can make a currency more vulnerable. And that's where Australia finds itself now. During the height of the mining boom, Australia enjoyed a rare current account surplus. Exports were booming, money was flowing in, and the Aussie dollar was flying high. But those days are gone. As of recent years, the current account has slipped back into deficit territory. That means Australia is now spending more on imports, foreign services, and overseas investments than it's earning from exports. On top of that, there's the issue of government debt. Post-COVID stimulus measures, while necessary, have ballooned national debt levels. And while Australia's debt remains manageable compared to some economies, the trajectory worries investors. It signals future constraints on spending, possible tax hikes, and growing reliance on foreign capital. In a global marketplace where capital is hunting for safety and strong returns, countries with twin deficits, budget and current account, start to look riskier. And when investors sense risk, they look elsewhere. The result? Lower demand for the Aussie dollar and downward pressure that's hard to reverse. Let's not forget the elephant in the room, the US dollar itself. Even if Australia got everything right, diversified exports, boosted productivity, raised interest rates strategically, there's still one giant obstacle, the US dollar. Because the truth is, the USD isn't just a currency. It's the global benchmark, the fallback in times of fear, and the anchor of the international financial system. When the world feels unstable, whether it's wars, inflation spikes, banking crises, or recession whispers, investors don't rush to the Aussie dollar. They flood into the greenback. Why? Because the United States, for all its dysfunction and debt, still runs the most liquid, stable, and trusted capital markets on Earth. It has scale, depth, and the kind of investor confidence other nations can only dream of. That means the USD gets a built-in advantage, a kind of gravitational pull that strengthens it even when the US economy isn't firing on all cylinders. So, it's not always that the Australian dollar is weak. It's that the US dollar is relentlessly strong. And when your currency is pegged against a financial superpower, it's a tough game to win. Even when Australia holds steady, it can still lose ground, not because it's failing, but because the USD is operating on an entirely different level. And in global currency markets, context matters just as much as performance. This isn't all doom and gloom, but it is reality. The Australian dollar isn't just low because of bad luck. It's down because of structural challenges that won't be fixed overnight. So, we need to boost productivity through tech, education, and infrastructure. Diversify exports beyond just resources and services. Invest in innovation rather than inflating house prices. Rebuild global investor confidence. Manage interest rates strategically while protecting households. But most importantly, we need a vision. An economic strategy that doesn't rely on commodity cycles, migration spikes, or real estate bubbles. Because the currency is like a report card, and right now, Australia's AUD grade is a solid C- with no extra credit coming. The next time you see the Aussie dollar struggling on the news, remember, it's not just a number. It's a signal, a reflection of how the world sees our economy, and more importantly, how we see ourselves. Until we change the story, the dollar will keep telling the same one. And if we keep ignoring it, we might just wake up one day and realize the world has moved on, while we're still wondering why our currency just can't keep up. Thanks for watching. If you found this insightful, don't forget to like, share, and subscribe. It really helps the channel grow. Got thoughts or questions? Drop them in the comments. See you in the next one.